Welcome to Iron Financial. This is the show where we help you forge a stronger portfolio by cutting right through the market weakness. Today, we're bringing out the heavy machinery and pointing it directly at Texas Instruments. They just dropped their latest earnings report, and let me tell you, the numbers are telling two completely different stories. So we're going to dig deep into their SEC filings, we're going to stress test their balance sheet, and we're going to figure out once and for all if this company is built on solid rock or on shifting sand. Let's get to work.
Okay, so let's set the stage here. Texas Instruments, ticker TXN, isn't just another chip company you hear about. No. They are a fundamental, load-bearing pillar of the entire global economy. Their analog and embedded chips, well, they're in practically everything, from the dashboard in your car to the complex robots on a factory floor. And because of that, they're an incredibly powerful bellwether for the industrial and automotive sectors. So when you look at TXN's numbers, you're not just analyzing one company, you're actually getting a direct read on the health of the entire industrial complex. Their story, in many ways, is the economy's story.
And right there, that is the multi-billion-dollar question, isn't it? I mean, you look at what management is doing, and they are pouring concrete and steel into the ground at a frankly astonishing rate. We're talking billions upon billions on new manufacturing capacity. Now, they'll tell you they're building an unbreachable fortress, something that's going to last for the next decade and beyond. But the skeptic in me, the part of me that's seen this movie before, has to ask, is this really strategic foresight? Or are they just digging a spectacularly expensive hole right in the middle of a cyclical downturn? Is this all hype, or is it real? That's what we're here to find out.
To get to the real truth, we're going to put this company through a really rigorous inspection, just like you would a building. First, we're going to lay out the bull case, the whole argument for why this is a cash-generating fortress. Then, we're going to bring the pressure and start looking for any cracks in that facade with the bear case. After that, we'll inspect the very foundation of the company, its balance sheet. Then we'll look at the blueprint for the future. That means their guidance and the risks they themselves are warning us about. And finally, we will render the iron financial verdict. Let's get started.
Okay, to really understand the bull argument for TXN, you have to start where all real corporate strength begins, the top line and the cash engine. Look, you can talk about grand strategies and 5-year plans all day long, but if the revenue isn't coming in the door and the cash isn't flowing, it's all just noise. For Texas Instruments, the bulls are going to point right to the numbers and tell you that this engine, it is absolutely roaring. The steel frame of their entire argument is sitting right here in these full-year numbers. Just look at this growth. Revenue is up a really solid 13%. It jumped from $15.6 billion to nearly $17.7 billion. That's over $2 billion in brand new revenue in just a single year. That's not a small move. That's not a rounding error. That is a powerful signal of strong underlying demand for what they make. And right below that, you see gross profit is up 11%, decisively breaking that $10 billion mark. This isn't trivial growth, folks. This is heavy-duty expansion. It shows that the demand for their core products remains incredibly robust. And this raw power is what fuels everything else in the company.
And listen, management is hammering this exact point home. The CEO, Javi Villan, he isn't starting his pitch with earnings per share or some fuzzy adjusted metric. Nope, he is pointing right here, directly to the cash flow from operations. He's saying that the nearly $7.2 billion that they generated in the last year is the ultimate, undeniable proof of their business model's strength. He's crediting their internal manufacturing strategy and their product portfolio. So when a CEO leads with raw cash flow like this, you know it's the absolute core of their entire strategy and the main message they want the market to hear.
You know, the sheer scale of this number is what's really staggering. $7.15 billion. This isn't just a number on a page. This is the financial engine room of Texas Instruments. This is the raw power plant that funds their research and development. It pays for those massive new factories they're building. And crucially, it's what returns cash to shareholders. It's up 13% from the prior year. You know, in a world of complex accounting and all kinds of adjustments, cash flow from operations is a measure of pure, unadulterated strength. It's the physical cash the business generates, period.
So here's the crucial point. What do they do with all that power from the engine room? They give it back to the owners. This is the ultimate proof of financial health and management's confidence in the future. Over the last 12 months, TXN has returned nearly $6.5 billion to its shareholders. Just think about that. That's almost $5 billion in dividends, a steady 4% increase, and another $1.5 billion in stock buybacks, which, by the way, they've ramped up by a massive 59%. Only a company with absolute, rock-solid confidence in its foundation and its future cash generation can commit to a capital return program of this magnitude. This, for the bulls, is the very definition of a fortress.
Okay, hold on a second. A fortress with a $6.5 billion moat? It sounds great, I'll give you that. But big, impressive numbers can be incredibly misleading. A lot of shiny concrete can hide a very weak foundation. So I think it's time we stop admiring the architecture and we start stress testing the structure. It's time to take out the hammer and see if we can find any cracks in this armor, because from where I'm sitting, they're definitely starting to show.
And boom, we find the first crack right here. So the bull case just celebrated all that revenue growth. But let's get granular and look at the bottom line for the most recent quarter, Q4. In the fourth quarter of 2024, they posted a net income of $1.2 billion. Okay, fine. A year later, in Q4 of 2025, despite having 10% higher revenue in that same quarter, net income actually fell by 3%, down to $1.16 billion. So I have to ask, what kind of growth is this really? You're bringing in more money at the top, but less of it is actually dropping to the bottom line. That is a serious red flag. It suggests that your costs are rising faster than your sales, maybe from all the inefficiencies of ramping up these new factories, or maybe it means they're having to discount their products just to hit that top-line number. Either way you slice it, it's a clear sign of deteriorating profitability.
And here is where a huge chunk of that money is going. This number is just staggering. $4.5 billion. That's the cash that went straight out the door over the last year for what they call capital expenditures. Building the new fabs, buying all the new equipment. Now, the bulls will call this investing in the future. Of course they will. But from a skeptical standpoint, you have to ask a much harder question. Are they investing, or are they literally setting billions of dollars on fire? In the highly cyclical semiconductor industry, building this much capacity is a massive gamble. You're betting the farm that the demand will be there when these multi-billion-dollar factories finally come online in a few years. If you time that wrong, you are left with enormously expensive, empty buildings that just bleed cash.
Which brings us to what I believe is the single most important metric for judging the health of an industrial giant like this: free cash flow. The bulls, they love to point to that big operating cash flow number. But that's the number before you pay for all the new machinery and the construction crews. Free cash flow is what's left after you pay all those bills. This is the real money. This is the cash that isn't already spoken for. It's the money that's truly available to pay down debt or return to shareholders without having to borrow more.
And this chart illustrates the problem perfectly. Just look at this cash funnel. On the left, you've got that big, beautiful, impressive $7.15 billion in operating cash flow. That's the engine we talked about. But then look at the massive bite that capital expenditures take right out of it, that negative $4.55 billion. So what are you left with at the end of the day? Just $2.94 billion in actual free cash flow. That means over 60% of the cash their operations generate is immediately being consumed by this massive building program. The engine is running hot for sure, but it's burning cash far faster than the bulls want to admit. And that dividend and buyback they're so proud of, well, it's being paid for with cash flow that barely covers it, and increasingly with debt.
And here is another pretty significant crack in the foundation. Texas Instruments isn't just one monolithic business. If you actually break it down by its annual performance, you see a tale of two very different companies. Their main business, Analog, it looks fantastic. I mean, revenue up 15% and operating profit up an even better 17%. That's a strong, healthy core to the business. But then look at their other major segment, embedded processing. Revenue growth there is really sluggish at only 6%, and its operating profit absolutely plummeted by 14%. This isn't a small dip, folks. This is a sign of serious decay in a major part of their business. Why? Well, it could be intense competition from low-cost rivals in Asia, or maybe the end markets for these specific chips, like consumer electronics, are just slowing down. Whatever the cause, the fortress has a weak wall, and it's a wall that's getting weaker, forcing that healthy analog business to carry the entire weight of the company.
A weak wall is a serious concern. A company's true durability, its ability to withstand economic shocks and downturns, that's ultimately revealed on its balance sheet. You know, revenue can fluctuate and profits can be managed with accounting tricks, but the balance sheet tells you the unvarnished truth about the structural integrity. So it's time to get out the blueprints and check the load-bearing walls.
And the very first thing we see is the total weight that this entire structure is carrying. As of the end of the year, Texas Instruments has over $18.3 billion in total liabilities. Now, this includes everything from their long-term debt to what they owe their suppliers. Now, for a company of this size, a large number like this isn't necessarily a problem in and of itself, but it is a substantial load that needs to be properly supported by the other side of the ledger.
And this is where it gets really interesting. The total support for all that debt, the stockholders' equity, is only $16.27 billion. So, for the first time, liabilities now exceed equity. This is a critical inflection point. From my skeptical point of view, the company is now fundamentally over-leveraged. What they owe is officially more than what they own. Now, to be fair, the bulls do have a powerful counterargument here. A debt-to-equity ratio over 1 would be extremely alarming for a company with weak cash flow. But as we've already established, TXN is generating over $7 billion a year in operating cash. They would argue that they're just using leverage strategically to fund this generational capacity expansion. It's aggressive, absolutely, but that massive cash flow means it's not necessarily unstable. At least, not yet.
Strategic or not, that's a fine line to walk. Look, past performance and balance sheet ratios are one thing. The real test is always what comes next. A huge building project is only as good as the future demand it's built to serve. And if we look at the company's own forecast and their officially stated risks, well, the blueprint for the future starts to look a little shaky.
But if you look really closely at their own guidance for the very next quarter, a really worrying trend emerges. They're forecasting revenue somewhere between $4.3 and $4.7 billion. Now, if you take the midpoint of that range, let's call it $4.5 billion, and you compare it to the fourth quarter revenue they just reported, which was $4.42 billion, you see the problem. Best case scenario, revenue is basically flat. Worst case, it's actually down. So after a full year of strong top-line growth, management is now telling you, in their own words, that the entire trajectory might be flattening out. That is a huge warning sign when you are spending billions and billions of dollars on new capacity that is premised entirely on future growth.
And finally, hey, don't just take my word for it. This is pulled directly from their own filing. Now, every company has a list of risk factors. I get it, but we should not dismiss this as just boilerplate legal text. This is a management-acknowledged list of all the things that could go wrong. They are explicitly telling you to worry about market demand, which, by the way, their own guidance suggests is already slowing. They tell you to worry about their ability to compete, a very real concern given the struggles we just saw in their embedded processing unit. And most importantly, they highlight the risk of not realizing returns on significant investments in manufacturing capacity. They are building a fortress, but they're also handing you the list of potential explosives that could bring the whole thing crumbling down.
So, there we have it. We've got the bull case for a powerful cash flow fortress, and we have the bear case, which sees dangerous cracks forming in that very foundation. We've inspected the top line, the bottom line, and the balance sheet, so now it's time to weigh all the evidence, put all the pieces together, and render the iron financial verdict. Is this an opportunity to buy into a future industry leader, or is this a carefully laid trap for unwary investors?
All right, let's lay out the final blueprint one last time. The bulls, they're standing on a foundation of really strong revenue and gross profit growth. That's all being fueled by that massive operating cash flow engine. This in turn allows for incredibly generous shareholder returns, and it's all supported by a dominant, highly profitable analog business. But on the other side of that same ledger, the bears see a completely different picture. They see declining net income even though revenue is growing. They see a huge capital expenditure burn that's eating up the majority of the cash flow. They see a key business segment, embedded processing, that's getting weaker. They see liabilities that now exceed equity and a forward-looking guidance that points to a dead stall.
So where does that leave us? On one hand, you can absolutely see this as the heavy lifting that's required to secure dominance for the next 30 years. This massive capital investment isn't a sign of weakness. It's a strategic act of building a wider and deeper moat around their business. They are consciously trading short-term free cash flow for long-term structural advantages in cost and capacity that their competitors simply won't be able to match. It's a bold, it's a necessary move to build an enduring fortress. But on the other hand, you can see this as an incredibly high-stakes gamble. The cost of construction is dangerously high, and it's putting immense strain on the company's financials right now. If that broad market demand they are betting on doesn't materialize on schedule, or if competitors find cheaper ways to innovate around them, investors could be left holding the bag on a very expensive, half-finished project. Ultimately, the question you have to answer is whether you believe this is a blueprint for domination or a gamble that's simply too rich. The decision is yours.